3 stocks at 52-week lows: Rogers Communications, Intel Corp, and Ball Corp. So let's start by evaluating them first. We're going to use our software. If you're a subscriber of the software in our community, please follow along. If you're not, I'll tell you how to do that shortly. So go to Stock Search, RCI, Rogers Communications. So what do they do? So I love using 52-week lows as a starting point to find opportunities. If a stock is hitting a 52-week low, there's probably momentum driving it lower, and it's a possible buy at that point. Does that mean it's a guaranteed buy? Please do not assume it's a guaranteed buy. I always make the analogy: if I have a house that's worth $300,000 and I decide to ask $1 million for it, nobody buys it. If I drop it to $500,000 in half, does that mean it's a good buy all of a sudden? No, it's still only worth $300,000. So don't confuse price with value. That's very, very important. So let's go to Rogers Communication. What do they do? The largest wireless service provider in Canada, with more than 10 million subscribers, which is about 1/3 of the total Canadian market. Wowzer. Okay. So let's go to let's look at this chart here. Hit a high of 61, a low of 43. Oh, it's bounced up quite a bit. Now it's at $46. All right. Let's go to the 8 pillars tab. So guys, this is the 8 pillars. Here's what I see right now. I see a few X's that are, okay, revenue growth. They've lost revenue. They've lost net income. They've lost cash flow. Okay. Interesting part is their gross margin is 40%, and that's about, I mean, obviously they probably have extra costs in here. So it's technically a declining company. So I want to sit here and use the 8 pillars to tell a story. So I see declining revenue and declining profit. Let me go right to the income statement. So here are the revenue numbers for the company. 9.8, 10, 10.2, 10.5, 10.8, 12. Then it's declining here and jumping up. So guys, slow growth or no growth companies, don't think that you can't buy them. You just got to buy them really, really cheap. Give you an example. If I had a company that's generating $5, $4, $3, $2, $1 of profit, then goes to zero, is there no value to that? It's still $15 of profit. You'd pay something for it. Are you going to pay 10 for it? I don't know, maybe. Are you going to pay 5? Yeah, you're going to triple your money. That's the point here. I want you to remember that a declining business is an opportunity for you potentially to buy, because the market will hate it and drive the price down, maybe to levels that are unreasonable. So net income. All right, so net income isn't as bad as I thought it was going to be. Is it down? Sure, it's down over the last 5 years, but kind of makes sense with the revenue being down, etc. So let's go back to the 8 pillars tab. They bought back a few shares, nothing crazy. A lot of debt here, guys. Oh boy, I do not like this. Their 5-year average free cash flow is $1.23 billion, and they have 23 times that level in debt, and I want it to be less than 5. So with that alone, for an investor like me, I'm going to pass on this company immediately. Why? I just hate the debt level. And I look at this saying, a declining company with this much debt, there are better opportunities out there. There are way better companies out there that are growing and have way, way less debt. So I immediately move on. So I didn't use our stock analyzer tool. And here's why. The stock analyzer tool is a starting point. And that starting point is after I've determined, you know what? I like the parameters here. What do I want to pay for it? So I'm going to ignore that right now. So we have 2 more companies to do, Intel and Ball Corp. And I'm going to use the stock analyzer tool on both of these. But for right now, if you like the software and what you've seen, it has so much to give to it, including this 8-pillar process. It has financial statements going back 30 years. It has news on every single company that you can look at up to date. It has real-time market data. It has all of this. And we created this because as I was using my Excel sheet in past videos 2 years ago, the most common question I got was, how do I get the Excel sheet? Well, the Excel sheet had a lot of data behind it that was expensive. So instead, we huddled up and said, how do we make the software for people? Because people want to use the software to evaluate their own companies. So we created the software so they could do the 8 pillars, but we decided to actually just do the 8 pillars ourselves, so it automatically told them. They use the stock analyzer tool. What's the stock analyzer tool? Well, every investment's the present value of all future cash flow. We have to make assumptions about the future because we don't know the future. This will sit there and take your assumptions and spit out a price to pay for the stock based on those assumptions. Now, where do you get that data? All in here, but the biggest aspect of our community is the chat. We have thousands of people active in here every single day talking about investments. Research is tough. You can use this community to do research. Everybody in there is talking. You can sit there and look up a specific company. Has anybody seen this? Is anybody looking at this? And you can have an engaging conversation about the company. This is all available for less than a cup of coffee per day. And let me show you exactly what you get here. You get all of this. You get the mobile app, the 8 pillars, the 30 years of financial data, stock analyzer tool, daily content exclusively. We post videos every single day in that community just for our community members. Access to us, real estate calculator, which is coming soon, stock screener is coming soon. All of these things for less than $1 per day. Our competition, quite expensive, and you don't even get everything you want here. And by the way, I still use Y charts here, but not every day. I use this every single day, and that's the point I want you to get. This is all available and can change the way in which you look at investing. So, company number 2, Intel. Now, Intel's a company I've been following for a while, and they recently shocked the world by revenue drop of 17%. So, it's not looking good for Intel. But look at the stock price. It's at 52-week low of $35. It was as high as $56 just a year ago. It is struggling right now as they turn things around. So the question you have to ask yourself is, are you a buyer of Intel? Well, look at this. 8 pillars. Their ROIC has dropped and their free cash flow has dropped. Now, ROIC, our ROIC number, return on invested capital, is calculated based on cash flow. So when cash flow drops, of course, the ROIC is going to drop. But they've been announcing this cash flow drop for quite a while now. It's been discussed that they're going to reinvest back in themselves and they're going to sit there and try to regain market share and stabilize and get better. This is a large company. In the last 12 months, they've done $73 billion in revenue. For this year, they're expected to do 65 or 68 billion. So it is quite the drop. But this is a good candidate to talk about in the stock analyzer tool. Because the stock is down so much, are people overreacting? So this is the stock analyzer tool. I'm going to do a 10-year analysis. You can do between 1 and 20 years. I'm going to use the 1, 5, and 10-year numbers on revenue growth, profit margin, and free cash flow margin to make my assumptions about the future. And it'll tell me, based on the multiple I select for PE and price of free cash flow, what to pay. So, first one, let's go conservative. Let's say Intel keeps losing revenue. I'm going to go -2% a year for the next 10 years. Let's assume they do 1%, and then let's assume they do 4% on the high side. Profit margin, I'm going to go 20, 21.5, and 23%. So still lower than their 10-year numbers. Free cash flow margin, I'm going to go 16, 19, and 22. Now remember, they've dropped free cash flow on purpose, so I can't fully punish them all the way because their free cash flow should stabilize and start to grow again after they stop investing back in themselves through capital expenditures. Now PE, I'm going to go 8, 11, and 14. And the same with price of free cash flow. Finally, my desired annual return. Guys, Intel is a large company. If the market can do 9 or 10%, you have to ask yourself, how much margin of safety do you want? I usually pick 12.5% for larger companies. You can pick whatever percentage, but the higher the percentage, the lower the price. I'm going to hit the analyze button. Now remember, if any of this was confusing, please rewind and rewatch it. The more you use it, the better you'll be at it. And it just takes, if you ask people in our community, it just takes a few iterations of it and you really get the hang of it. So scroll down. All right, it's a little mixed bag here. We have a low of the low 20s, a high of the low 50s, and in the middle is about where it's at right now. So to me, this indicates I need to make sure I feel comfortable with these numbers above. Now, I will say, this is a very low multiple for a company like Intel. And I do believe in their long-term plan of turning things around, in addition to the fact that the chip market in the world is expected to grow 12.2% over the next 10 years. So even though Intel's share of the market will be lower, if the pie is growing like crazy, they can still grow their revenue. And Intel is still a big leader in chips. So, company number 3, Ball Corp. Let's go check them out. Let's go back to our home. What does Ball Corp do? It's an $18 billion company, the world's largest metal can manufacturer with a market share of 40%. Holy cow. That's incredible. Okay, beverage packaging and things like that. That's interesting. All right. Let's look at their 5-year chart. Oh, big drop recently. What happened there? From $70, they fell recently from $83 in May and then $72 down to, oh my gosh, $57. Okay, let's look at the 8 pillars here. Okay, a lot of X's here. So first things that jump out at me. very high PE, very high price of free cash flow. So to me, why are they buying back shares when the stock is selling for really high multiples of free cash flow and earnings? So even though it's a check mark, I don't like when they buy back, because this is after the stock has fallen from $80 some a share down to 50 some. Revenue growth, net income growth, free cash flow has dropped. And again, lots of debt. 22 and a half times their average free cash over the last 5 years. But look at this. Free cash flow the last 5 years, $467 million. That includes negative $300 last year. And they're paying out $244 million in dividends. Oh boy. Guys, hate to say it, another example of a company I'm just ignoring purely because of the debt number. And I don't like, let me go look at this cash flow number. Let's see if there's anything here so this is the cash flow statement. As part of the software, I've added this line of free cash flow. And look, this $467 million includes a fluke year of $1.1 billion. But it also includes a negative here, which is very rare for them. This is interesting. So let's say the average is really more like going back 350 and they're an $18 billion company. Yeah, I'm just passing on this one. So if you like this whole process and want to learn more about our 8 pillars, please click the link above where we explain the 8 pillar process in more detail, and also subscribe to the channel. I appreciate your time. Thank you.